there we are. It's Thursday. That means Broker Talk. We got a great show coming on. Hope you guys are feeling good. Get your coffee and let's sit down. Today on our show, we have, first of all, let me introduce my co-host, Jim Lowenstern from Castles Unlimited. How are you doing today, Jim?
Thank you. I'm doing really, really well. Thank you, Larry. Glad you asked. How are you doing?
I'm pretty psyched. We're going to be talking about lending, loan officers, and how you get money in real estate. And for
Okay.
that, we have Craig Barber from Fairway Mortgage, senior loan officer, knows a ton of stuff. So, hey, Craig, welcome aboard.
Hey, Larry, I'm having trouble hearing you.
Of course.
You're having trouble
You
hearing
haven't
me?
you haven't seen our show
No, I
before.
haven't. Jim, I see. I
This
hear
is
you.
this is how we started every week.
Larry, you went out once you started playing that music, but I think you asked here. I'm doing
It-
well.
it-
Thanks for having me.
Yeah, well, don't worry. It'll come back and it'll get louder and louder. And we actually found the reason for that. So I must not have come over
Yeah, we
soon.
didn't pay the electric bill.
Yeah, yeah. I hear Jim. I hear Jim loud and clear. Hope you guys can hear me.
I paid my electric bill.
Yeah, I paid my electric bill too. I just, anyway, this is why people like this show because we spend 5 minutes complaining about it at the beginning. When people go out to buy a house, they often think very simple things. And I just need to get a loan. I just need to have enough money to get a house. What kind of questions do you get, Craig, when someone comes in? What's like the standard question that you get that you like to answer?
Yeah, and I get this question every day. It's actually so I've been doing this for some time now. I've been got into business in 2003, and it always amazed me. It's the same question I hear every single day when I'm talking to a first-time home buyer, whether they're buying a second, third, fourth home. It's, hey, I want to buy a house. How much can I afford? Right? And I
Yeah.
love that. I'm like, well, I don't know. Like, what do you want to spend? Just because I could qualify you for something doesn't necessarily mean you should buy it, right? Pretty generous. When I first got into business, we were able to go up to 55% gross debt to income ratio for qualifying for conventional financing. And, for a period of time after 2008, 2010, went down to about 40, 41%. But now we're at back up to 49.9 for most conventional product. Again, that's gross income. So it's really about 80, maybe your take home pay to total debt, which most people shouldn't be at. But again, I get that question every day and I love it. And it just amazes me that people don't really start thinking about kind of their budgeting first before they ask that question. More concerned about what can I buy?
I did a quick Google search and I said, what are the kinds of questions that people get asked all the time? And one of them was they want to, whatever money they get, they want to spend all of it. And I always tell my clients, don't do that. You're going to get your house and then you're going to want to paint. You're going to want to, get a sofa, get a new TV. So you don't want to be at the furthest end of what you can afford just to buy the house, just to get in the house. I think that's one of the mistakes that so many people make. But right now in this market, and Jim, you have some properties that are like this. People are overbidding 30, 40, 50, $70,000. Some of my buyers just recently $70,000, and those properties will probably not appraise for that amount. Do you think?
Yeah, it's a question that we've been answering a lot recently as well, right? It's a seller's market, no question about that. It's supply and demand, right? There's more buyers out there than our sellers, and that's creating that bidding war. And whenever I chat with buyers and kind of go over this question all the time, and I kind of remind them that every new sale is kind of creating that new floor, right, for value, because appraisers have the hardest part of the real estate transaction, in my opinion. They look backwards, right? They're looking backwards at recent sales rather than forward, where the homeowner is buying today and starting their life there.
Yeah.
So the appraiser's job is, to support the value based on today on previous sales,
Right.
And this time of the year, right now, it can be a little challenging because it's first quarter, right? Most people aren't buying, selling, and moving over Thanksgiving and then the holidays and New Year's. Most people have already done that. School started, so that happened, right? So first quarter for real estate could be and can be historically tough for appraisers looking backwards. The one thing I would add this year, and you're absolutely right, Larry, people are bidding, it's percentages. I look at the percentages, 1, 2, 3, 4, 5, whatever, 10% above asking. But I think this year, knock on wood, I don't want to start jinxing all my buyers out there, but it actually hasn't been as bad as really what I think, they may seem. And what I mean by that is we didn't really have a spring market last year, right? That spring market kind of got pushed and punted into fall, maybe even early winter, just because of what happened in the stays that were put in place. So a lot of these appraisers have a lot more data to support some of these prices today over the last or previous quarter than they would have historically. So again, I'll knock on wood. I haven't seen too many in Greater Boston, really inside that 128 Beltway, that the appraisals haven't been coming in at that asking price, even above whatever is listed for.
So
Well,
traditionally,
I had to,
go ahead,
let,
Jeff.
let me interrupt first. So I have a funny story that happened today. So I have a house that's on the market for 2,895,000, and we got a full price offer. And there's a little work that still needs to be done, and a few changes that need to be done, and there's a few upgrades that the buyer's going to pay probably about 17. Well, actually, they're getting maybe $6,000 more out of pocket. It's not much of anything, but they're also doing a closet. So maybe let's say it's 15,000. So now it's 2,910,000. He was upset that the appraisal came in at 2.9. I know. I mean, seriously, if you could afford a house that's
Yeah.
that kind of money, you should be able to suck up that extra $10,000, I guess.
Yeah, and where I sit too, guys, and I guess the misconception a lot of buyers have, especially first-time home buyers, they think let's say it does come in short, right? Let's say it does come in below what they're offering. As a buyer, you don't necessarily need to make up dollar for dollar that shortfall, right?
Right.
Based
Just
on
a
percentages.
percentage of it.
Correct. And a lot of people think, all right, if I'm going 10% above asking, I got to come up out of pocket on that, right? So it depends on what that buyer is putting down, right? So in Greater Boston, you could get financing up to $724,000, 724,500 with as little, I say, as little as 5% equity, right? So it's basically a 760, 765 purchase price with 5% down. So the buyer needs to maintain at least 5% up to that 724 loan amount.
But that's going to have PMI, right?
It would have PMI. Then we build in strategies whether or not you actually need it, right? So PMI, yes, if you pay monthly, there's all kinds of other strategies of financing it. If there's still room, you could always maybe some of the negotiations back and forth, even buy it outright, right? So that's another strategy we just did. It was actually the fourth quarter, but they would have had PMI, but rather than come up with an extra 5%, they basically paid 1.25% on top of their down payment and bought out the PMI. So they were left with the exact same financing originally applied at, even though they had to bid up to get that house they wanted.
So let's describe terms because we have people who have not done this.
Sure.
PMI and
Private mortgage insurance, yeah.
private mortgage insurance, and your mortgage can also include your taxes and insurance, your house insurance. So it's not mortgage insurance; it's house insurance. That's called PITI.
Yeah, PITI as we call it, right? PI principal, I interest, T taxes, and I insurance, right? And if you have to add that extra PITII, you
Right.
mortgage.
So I think a lot of people, a vast majority of them, don't understand that a loan, a mortgage, is a product. And there are a lot of people that sell products. I try and describe it, es- es- especially because women usually make the decisions on all this in a couple. We all laugh about it, but it's true. And I describe it like you can buy the red high heels or you can buy the black pumps. Both of them you're going to like. One you're going to look beautiful in, and one you're going to be able to walk down the road comfortably in. So, loan is a product. And I think another thing people don't understand is that banks, Bank of America, Wells Fargo, Chase, those people who write up your mortgages do not have to have the same training that a mortgage company loan officer has. Could you describe or explain that a little bit further?
I
Yeah.
want to know what the pumps are.
Yeah. Yeah. So
Flat
when you work at a
shoes.
bank, flat shoes,
Well,
exactly.
it doesn't make any sense. Why are they pumps?
Like the old
What's
Reeboks.
it called?
Back
Flats.
in the 80s. Yeah. So when you work at a bank, you have to be what's called registered with the the National Mortgage Licensing Board, but you don't have to pass a test, right? So you just have to register, you sign up, and you get a number. And then at a bank, you can just start doing mortgages, right? At a bank, at a credit union, at a depository lender. Where we are on the private side or retail side, whether it's us or even mortgage brokers or large lender, you have to not only get registered, but you also have to take a test, right? It's 20 hours to get your initial test. It's a uniform test throughout the country. You get all 50 states, and then you have to take the state test on top of that. And then it's continuing education, right? So it's another, I think it's 8 hours, and each state has specific tests as well. So really, the major difference is we need to maintain a license and continue to be, I guess, educated on what's happening.
Right.
Where that's not always the case in the banking side of it.
Yeah. Not unlike the difference between a realtor and a sales agent. You know, there are lots of people out there that don't have that extra training. They're not they don't have an ethical code like National Association of Realtors are. You know, so you have to study,
Yeah.
and you
I
have to.
think our probably similar to your world, right? The first time you take the real estate test, I don't know what the success rate is or pass rate. Ours is about 50%. I think it's around 50%.
Oh, really? Yeah.
It's much higher.
Much higher.
You think that?
At least in Massachusetts.
Yeah.
Well, I think of, you can be an idiot and get a real estate license. That doesn't make.
In Massachusetts.
I think in anywhere.
Yeah. Florida, the pass rate is about 50% the first time around. Just saying, I know. 50% of my class, but that was like decades ago. The test is probably harder now. It's 70 hours down there. There's some states it's very difficult.
Texas, I think it's 240 hours of study. When I got that license, but they, anyway, let's move on because that's not about lending.
Well, I want to ask Craig. So, Craig, you work for, was it Fairway?
Correct. Fairway.
Fairway. And Fairway is an originator or actual. Explain the whole. Why don't you explain the whole industry?
All right. So yeah, we'll get down to the business, right? Because you guys have all heard terms, lending, banks, broker, right? What kind of
Loan originator, for example.
Loan originator, right?
LO.
Mortgage advisor, LO. So you go to a bank. Again, they're just going to have that bank product, as Larry talked about before. Most banks service their own loans, but they're also securitizing or selling them to Fannie Freddie. They just retain services. You pay, Larry, as you said, Bank of America, Wells Fargo, Chase, right? You only have that. The term mortgage broker, which for a period of time kind of went away, is starting to get popular again, where you're just a middleman. You're just a person collecting the information and you're sending it out to whatever lender you want to work with, right? That crashed back in 2008 to 2010. That's when you heard of the implometer, right? When you guys remember, I don't know if you guys remember that term, but banks and lenders were closing every single day. The product was going away, right? The securitization, those bonds were going away.
What was the term?
The implometer. You log online. I mean, again, in my world, you log online and you see on whatever, Bloomberg or NBC, whatever, 10 more banks close their doors. They weren't necessarily depository banks. They were lenders that securitized mortgages. Right, so that's a broker, just a middleman.
You're talking about the,
that credit crisis, you want to call that back then?
Yeah.
2008 to 2010.
What was the kind of mortgage that collapsed?
Subprime. That was a big one. Subprime stuff, right?
Subprime, countrywide. That was the tipping point, right?
But yep, the fast and easy, or as we used to
You have a dog. The dog can have a mortgage.
Everyone.
Dog doesn't even need a job. Yeah.
Yeah, the option arms, right? The negative amortization was a big one back then as well, right? So that and that doesn't exist anymore. That product is But the term broker kind of went away with it, because what happened was you had to have a little bit more skin in the game to start doing mortgages again. Meaning you had to make credit decisions, you had to fund your own loans. You didn't have to retain servicing, meaning collect payments, but you had to at least fund the loan. You could sell them afterwards. I will say mortgage brokers are making a comeback, so we are starting to see them again. It's not what Fairway is. Fairway, we are a lender. We're actually one of the largest lenders in the country. I believe we're the 5th largest lender, and this may make no sense to anyone, but we're the largest non-bank, non-call center lender in the country, right? So last year we did about $70 billion in originations. Now, do we hold our own mortgages, which I think, Jim, you're kind of asking. We do service, collect payments on a piece of our business, but we do securitize and transfer a majority of it. It's not, the servicing side of the business is not something that we're, we don't hold all of our paper or all of our mortgages. We securitize most everything through Fannie, Freddie, and then Ginnie Mae, which is the government product, FHA and VA.
So let's break it. It's Fannie Mae and Freddie, and you have to be Fannie or Freddie eligible for that loan to be sold to a different servicer. So
yeah, so I guess those things go back further, right? So, and when I talk to my clients, I try to explain this, because I love one of my other favorite questions, guys, and not to go too much into rate, but what's your rate, right? I love that question. And mortgages, yet they're debt to you and I, but remember, they're assets to everyone else. They're in pension plans, 401ks, they're in insurance policies. So someone collects that interest, but it's an asset, right? Debt to you and I, the consumer, asset to someone else. The asset itself is a bond, right? It's you think stocks and bonds. So mortgages are a type of bond that trades or opens and closes every single day in the market. Think stocks, right? So a price of a bond, right, that yields or has a yield or a rate goes up and down every single day. So when we talk about rates and these products, a rate today could be different tomorrow, just because of how these bonds trade. So a lot of times consumers don't understand that. They just think call a rate for today, it's good forever. That rate can move or go up or down any given day at any time throughout the day as well.
Huh. That's interesting.
So what are rates doing right now, Craig? Because,
right now,
they're saying the Fed basically has rates at 0.
Yeah, so that's another
mortgage rates are not 0.
That's another media misunderstanding of how the mortgage world works, right? The Fed does not and cannot control mortgage rates. What they control is something called the overnight lending rate, or the Fed fund rate. That's, Jim, what you're talking about, between 0 to 0.25%. That's tied to all short-term lending products, home equity lines of credit, credit cards, right? So that's what the Fed controls. What the Fed has been doing to manipulate or bring our rates down to levels we've never seen before is buy mortgage-backed securities, the bond, at levels we've never seen. So if you guys, not to keep this, try to keep this a little simple here, but as you buy down or buy down bonds, the price goes up, the price of a bond goes up, the yield or the rate goes down. So the Fed is basically buying $30 to $40 billion a month to keep rates where they are. So they can't control mortgage rates. They're manipulating by having this bond buying program.
Yeah, it's all scary to consumers once they begin to think about all of this.
Yeah, it is, right. And I don't have the exact numbers, but I think everyone can kind of get the understanding of this. From 2008, 2009, when the Fed came in to help, save the housing market or stimulate the economy, we all heard that term quantitative easing, right? QE1, QE2. What they did, they were buying bonds to drive rates down. Again, don't quote me on this. They bought somewhere around 800 to 900 billion in mortgage-backed securities in that 2-year period. From March through September, this past year, 2020, the Fed bought about over $1 trillion in mortgage-backed securities to drive rates down, right?
Yikes.
So the investment in the economy was real, right?
Yeah. Well, we need the investment in the economy because we're all stuck in our houses for the most part. Hey, we're going to come back in a moment. We're going to pay some bills here, and we'll see you in a moment.
When you are searching for a new home, you want to be working with a realtor with years of experience, a professional with intimate knowledge of the communities that you are considering moving to, and someone who really wants to represent you as a buyer in what is probably the largest investment you will ever make in your lifetime. The realtors at Castles Unlimited want to be your choice when you are ready to make your next move. Please visit us at castlesunlimited.com or call us anytime at 800-967-3561. The realtors at Castles Unlimited are here to help your next purchase, lease, or sale of any real estate the easiest decision you've ever made. Start your search anytime, 24/7 at Castles Unlimited.
And we're still talking
We're
about
going to have to do
shoes.
something with you.
And we're still talking about shoes. Jim's trying to understand footwear.
Oh, no, I understand it perfectly.
Perfectly. Okay. Um, price.
Mortgages, not so much.
Yeah, right. Mortgages, not so much. I'm just checking to make sure everything's still good here and the show is still moving. There we go. Everything looks great.
Right. So what's the most popular product right now, would you say, for most of your clients?
It's the vanilla 30-year fix. There's not much deviation from the 30-year right now. And there's a reason why for that too, technical reason, but for the most part, every consumer is basically just getting that typical 30-year fix. There's not much other deviation from that.
A lot of juggling going on out there. Um, but a lot of great opportunity. And are you doing as many refis as you're doing new home purchases?
Yeah, again, like I said, I've been doing this since 2003, so been fortunate enough to have a decent sized book and helping out a lot of clients with the refinance. Again, we're seeing rates we've never seen before. And I got into business, it was I think low sevens down to high sixes, and it was a refi boom, right? And everyone said back then we never see rates at those levels again, and slowly they've been going down. And I've been saying for the last call it 10 years or so, rates are going up. I've been wrong every year. So
Right.
I do think I'll be right this year. I do feel that we won't see these level of rates again. I think they'll be here for a period of a year, throughout most of the year, sub three, but rates will start ticking back up. They
have
want to. Yeah.
And we want our economy to be booming, and it's being propped up, not artificially, but using manipulate tools to manipulate the economy. Just so get out there and get a job.
Yes, yeah.
And
Yeah.
buy a house.
Buy a house.
And buy a
People
house. Well,
find-
there are so many people. Here's another thing that's just crazy right now is the number of people that, because the inventory is so low. I was at some open houses this weekend with some of my buyers. 60 and 70 people, families, are lined up to get into a three-family. I mean,
Well, okay. So let's put in perspective. Besides looking at houses on the weekend, how many other activities can a family plan right now? Okay.
you think
I
that's
mean, here's my theory on that. Yes, there are a lot of people looking, and yes, there's for more people will show up at the ones that are available. But at the same time, people have to be creative. They've got kids, for example. Kids, we're going to buy a house. Really? Yeah. So we're going to spend a lot of time looking at houses. Well, what's the option? Well, they got to build a skating rink in the backyard and teach the kids how to play hockey. Which is easier?
Having a backyard hockey rink, looking at open houses is much easier. I'll tell you that.
I'm not so sure, Jim. I don't know the last open house you went to, but I stood in the snow for 45 minutes with people trying to get into a house. These are people who are masked up. They're not
horrible.
out there for a social deal. It's not a social deal
I
to them.
know. I'm joking, and it's horrible that it's like this, but it has to do. I mean, we're in New England. We just have a different mentality than other parts of the country with our zoning and everything. It's very difficult for builders to. I have a house. We're trying to build a house. Historic came in and shut down the job site today. The house has been rotting. It's a 1700s house, and they're having a hissy fit. Meanwhile, the whole house is rotted. They want us to save the facade of the house. There's no facade there. As soon as you touch it, it crumbles. So, it's just the problem here. That's
Part of
all I
the
can say.
$1.9 trillion budget that the president is trying to push through includes changes in the federal level of zoning, and also they're going to make sure that the tariffs are lifted off wood and some of the products that are being used in our building, which should be a big help for those. The zoning issues, our show goes all over the world, but we're here in New England where there's a finite amount of space. So zoning, if you were in a town Weston, you need an acre. Um, in some of the other towns, I think Sudbury, isn't it 2 acres in Sudbury? Jim, do you know the fact on that?
It's an acre sounds right.
Um, but it,
I'm sure there's some neighborhoods where there's more, need more square footage.
but the point
But you're
is,
right.
an
You can
acre,
build,
a bunch of houses.
you can build more than one house on an acre. Yes.
Yeah.
And then they can be decent sized houses too.
How about all these people, my age group, who have parents who are still alive, and the parents are in a big house, but they need some help. Why can't you build a tiny house on your existing property? You
You
can't
can.
because of the zoning, depending on
Well,
the area.
they are, the floor area ratio, how large a house you can build, but most towns will allow accessory apartments. For some reason, they don't like ovens. Bathrooms are fine, sinks are fine, refrigerators are fine, cooktops are fine, microwaves are fine. It's just ovens. They don't
Well,
like
the,
ovens.
the the ovens or the stove is a way that you can then move in and live because you can cook. Um,
Well, you can get a cook, there's big, I don't know, countertop ovens. Maybe not as, not going to have a turkey in there, but there are plenty of people that are living in accessory apartments. So that's how you have to get around it.
Right, but it's
There's
not
always a
easy.
way.
It's not
There's always
easy.
a way.
It's not mainstream. Tiny houses, I love the idea. She sheds, but they're really tiny houses. Um, and there are many people who, um, if you can't find a first floor bedroom for your parents because they can't do the steps anymore, your mom, your dad, a tiny house is a great way for your own private space as well. We need to make some of those adjustments in the future.
And going back to Craig and mortgages, if someone has a little accessory apartment and they're trying to get financing, house towards your income in the calculation.
Depends, right? So we'll conservatively say you could take 75% of what that rent would be and add it to the income.
Okay.
From
So
from the person lending, I mean from the person
yeah,
borrowing.
so call it $1,000 a month. We use 750.
Let's say the place is someone's buying a two-family, they're going to move into one. The other unit is rented. There's a lease on it, and it's below market. Is the current rent the number that they use, or is it the market?
So are we going? It depends again. FHA or conventional. FHA we use market rents.
Okay,
Actual.
take the actual. And what if there's
With-
6 months left on the lease, and the buyer says, "I am definitely raising the rent, or I'm going to get another 10." Doesn't
Yeah.
matter.
It doesn't matter. No, we wouldn't go on because again, it's a contract, right? So a lot of times where I come in, it's we try to qualify everyone without that anyway, right? So we try not to even use that income for qualifying, but if we have to, we get creative.
So let's address
Creative. Good.
yeah, address
With,
the
doc- with actual documentation.
let's address the other side that's going on right now. Is this people that have been out of work that aren't able to pay their mortgages and forbearance, which means that the bank is going to put everything on hold until we figure it out. What do you think it out? What does that mean?
Exactly.
You're still going to owe the money. They're probably not going to remodify that, although they could at a lower interest rate and make it. What do you think the banks are going to do about this?
So it's not. So again, when this first rolled out, we like talk in our industry a lot of unintended consequences, right? Because we had to move fast. Last year, no one knew what was going on. Everyone moved very, very fast. And I mentioned before, guys, mortgages, yes, debt to you and I, but they're assets to everyone else, right? So they're in pension plan. They're in everything else. It's almost like if you don't pay your mortgage, your mother's not getting her pension. So it was complicated. And there was a lot of unintended consequences. And one of them, the government was basically saying, and rightfully so, you don't have to prove hardship. Because if we go back to that last crash, we had to prove hardship for the modification. So what happened? foreclosures, pre-foreclosures, and that created another whole can of worms. So
Right. You literally had to stop paying your mortgage.
and servicers were advising you, right, Jim? Servicers were saying, stop paying, you're underwater.
Absolutely.
So
wreck your credit to get a better mortgage.
So fast forward this time around, it was don't have to prove anything. I don't care if you're still working or you still have whatever ability to repay. And what that caused the servicers was saying, all right, okay, you stop paying, we'll give you 3 months or 6 months, whatever you negotiate, talk through it. And most people assume to just be billed on the back end. Not always. So now rates drop to levels that we've never seen before. You want to take advantage of these rates. Again, we were talking last year when this first happened. Well, you haven't made 3 payments. So not only can you not refi unless you come current, the people that originally had the ability to make 1 payment do not have the ability to make 3 to get caught up. So they weren't able to take advantage until they got caught up, right? So the forbearance was there for a certain reason. The people should be taking advantage of it. But the people that had the ability to continue to pay should have. If they want to take advantage of today's rates. And it's gotten a little bit more lax today. We are able to kind of build that back into loan. It's becoming easier. But last year, when this first happened, it was a tough process. We didn't know either, right? So we were kind of going with the flow, and we were being told we had to. But then the servicing side is like, well, if they don't make their payment, then from a lender, we have to buy loans back. It was a tough period of time last year when this rolled out. But hopefully, it did help a lot of people, and the people that needed it were able to take advantage of it.
Okay, so 1 or 2 more questions, and I think we're out of time. What's the lowest amount that you can write a loan for first mortgage?
For first mortgage, the lowest I think I've ever seen was like $42,000. To a certain point, something called high cost lending. Again, it makes no sense to anyone until you start getting the numbers, but at a certain loan amount becomes too low and you can't actually qualify for financing.
Okay. And then the maximum for conventional family?
Maximum conventional in our area in Greater Boston, 724, 500. And you can put as little as 5% down up to that, which is pretty generous, right? 766 purchase price.
And then for a 2-family, what is it?
You can ask those questions, much higher you're in the 8s.
Okay. All right.
4 families, like 1, 2, I believe right now this year. And these
you
numbers change, right? They're based on your average median sales price. But yeah, no, 724. Last year was 688, so it's gone up quite a bit.
And what about investor loans? Do you do those?
Yeah, we do. Absolutely. Yeah, the only time you really have to worry about investment properties, the property itself comes into play, right? Most want to buy multifamily, so yes, 25% down. We used to have a 20% down option. That went away last year with the COVID product kind of shifting. So we do require 25% down now. And then condos come up for investment properties. So it really is important that you work with your agent to understand the characteristics of the association if you're going to be an investor buying into the product. I'm sorry, association.
The point here, Craig, is that working with a professional who understands all this helps you. It's seemingly easy to buy and sell a house. That's why a lot of people think they can use some discount brokerage because I'll save some money. That usually does not save them money.
No, and not using names. There's certain broker shops out there. When I see my buyers using them, I just know it's gonna be a headache.
Lending Tree, Rocket Mortgage.
We're talking on the broker side, from the realtor side.
Yeah.
Oh, discount realtors.
Yeah.
It never goes as planned, right? It's never as smooth as it is if you work with someone that does it, that take the job seriously and really understand the industry.
Yeah. Well, if it's seriously, I would seriously suggest that you talk to Craig Barber from Fairway Mortgage. Thank you so much for being our guest today.
Thank you, guys. It's great.
If you need great agents, call Jim or I. We love doing what we do. So it's been a pleasure. We've already wasted another 30 minutes enjoying us.
Broker talk. .com. Broker-talk.